Welcome, everyone. I'm absolutely delighted to have you here today for what I can confidently say will be a transformative journey into the world of professional trading. This is the Volume Profile Trading Advanced Continuation course. Now, if you've already completed episodes 1 through 3, you'll know we've covered the foundational elements, the building blocks, if you will, of volume profile analysis. But today, we're taking things to an entirely different level. You see, what separates the consistently profitable trader from someone who's perpetually struggling isn't just knowledge of the basics. No, it's the ability to make nuanced, discretionary decisions in real time. It's understanding not just what the levels are, but how to classify the quality of setups, when to be aggressive versus cautious, and why certain confluences create extraordinarily high probability opportunities. So what exactly are we covering in this advanced continuation? Well, we're diving deep into setup quality, ranking what I call the ABC classification system. This is absolutely critical because, you see, not all touches of a volume profile level are created equal. Some deserve immediate aggressive action, while others require patience and confirmation. We'll teach you exactly how to distinguish between them. We'll then explore the three-factor analysis framework in remarkable depth. This is where the rubber truly meets the road, combining level history, trend reading, and rejection candle analysis into a systematic scoring approach that removes guesswork from your decision-making process. And here's something fascinating. We're going to completely reframe how you think about levels. You see, most traders obsess over exact price touches, missing brilliant setups because price came within 2 or 3 ticks of their line. We're going to teach you the levels as zones concept that professionals use, giving you the flexibility to capture high-quality trades that rigid thinking would cause you to miss entirely. We'll master stop-loss placement, not just where to put them, but why certain placements survive the inevitable retests while others get hunted. We'll develop a targeting hierarchy so you always know where to take profits, whether that's structure, volume profile levels, or fixed risk-reward ratios. Then comes confluence stacking. This is where multiple independent confirmations align at a single point in time and space, creating what I call golden setups. Weekly point of control meeting daily value area low with a bullish trend and rejection candles. That's not just a good trade. That's a trade you should be sizing up on. We'll provide session-specific playbooks because, quite frankly, the London session behaves differently than New York, which behaves differently than the Asian overnight period. Each requires its own approach, its own timing windows, its own strategic considerations. We've broken down the overnight period into 3 distinct trading windows: early overnight from 6:30 to 11 p.m., deep Asian from 11 p.m. to 3 a.m., and London Open from 3 a.m. to 9:30 a.m., each with precise timing and tactical guidance. And perhaps most importantly, we're going to discuss something that simply cannot be taught through rules alone: earning your trading intuition. How do you develop that gut feeling that seasoned traders have? We'll lay out the pathway. 200 rule-based trades that gradually transform into discretionary mastery. Throughout this course, we'll maintain our color coding system for absolute clarity. Orange represents weekly levels. White represents daily regular trading hours. Blue represents overnight sessions. And green represents your current developing session volume. The goal here is elegantly simple yet profoundly powerful. We're going to transform objective volume profile levels into high-probability trading decisions that you can execute with confidence, consistency, and conviction. So settle in, bring your focus, and prepare to see the markets through an entirely new lens. This is where good traders become great traders, where theoretical knowledge becomes practical mastery, where hoping becomes knowing. Let's begin this journey together. Now, let's address something absolutely fundamental, something that, quite frankly, transforms the way professional traders think about volume profile levels. This is the setup classification system, and it's going to change everything about how you approach your entries. You see, here's the problem most traders face. They treat every touch of a volume profile level as if it's created equal. Someone sees price approaching the previous day's value area low and they immediately think, right, I'm going long here. But that's precisely where amateur traders get themselves into trouble. The reality, and this is crucial, is that not all level touches are the same. Some setups deserve immediate, aggressive action. Others require you to sit on your hands and wait for confirmation. And some, Well, some you should skip entirely. This is why we've developed what I call the ABC classification system. Think of it as a quality control mechanism for your trading decisions. It's the difference between forcing trades and selecting only the highest probability opportunities. Let's break this down systematically. An A-grade setup, this is your bread and butter, your high-confidence trade. This is where the trend is aligned with your direction. The level has a documented history of reactions, and you're seeing strong rejection candles at the zone. When you identify an A-grade setup, you act fast. You enter aggressively. Your stop is relatively tight because everything is in your favor. Now, a B-grade setup is different. This is where the trend might be against you, but the level has history, and you're seeing some rejection. It's not a bad trade, far from it, but it requires a different approach. You don't rush in. You wait for confirmation. Perhaps you wait for a strong move away from the level or a micro break of structure in your direction. Your stop needs to be wider here because you're anticipating a retest. B-grade setups can be excellent trades, but they demand patience and discipline. And then we have C-grade setups. These are the traps, the low-quality opportunities that destroy trading statistics. First touch of a level with no history? That's a C-grade. Unclear trend with choppy conditions? C-grade. Weak, indecisive candles at the level? C-grade. These are the setups you must learn to skip. Protecting your statistics by avoiding forced trades is just as important as executing the good ones. The outcome of this classification system is rather profound. You stop forcing trades. You set clear expectations before you enter. You know whether to be aggressive or cautious. And most importantly, you avoid the psychological trap of treating every level touch as if it's a must-take trade. This is discretionary trading at its finest, using objective criteria to classify subjective market behavior. It's systematic, yet flexible. It's rule-based, yet adaptable to market conditions. So as we move forward through this course, I want you to constantly be asking yourself, is this an A-grade setup, a B-grade setup, or a C-grade setup? That single question will dramatically improve your trading outcomes. Excellent. Now let's dive into the specifics of what makes an A-grade setup your absolute bread and butter trade. But before we discuss the setup itself, let me clarify some critical technical terminology that you absolutely must understand. When we talk about the previous day's value area low, we abbreviate this as PDVAL. We're referring to a very specific level. This is the lower boundary of where 70% of all trading volume occurred during the previous day's regular trading hours session. And here's what's crucial. Regular trading hours, or RTH, runs from 9:30 a.m. Eastern Time to 4 p.m. Eastern Time. That's the New York stock market session, 6.5 hours of trading activity. So every single day, after the market closes at 4 p.m., you draw your fixed range volume profile from 9:30 a.m. to 4 p.m. on a 1-minute chart. The volume profile will show you a highlighted area that's your value area, representing 70% of the volume. The bottom edge of that highlighted area is your value area low. That level then gets extended forward as a horizontal line, and that becomes your previous day's value area low for the next trading day. We mark this in white on our charts to differentiate it from weekly levels, which we mark in orange. Similarly, the previous day's value area high PDVAH is the top edge of that 70% volume area. And the previous day's point of control, PDPOC, is the single price level within that RTH session that had the absolute highest traded volume. These three levels, VAL, POC, and VAH, are the foundation of our daily trading framework. Now, with that technical foundation established, let's discuss what makes an A-grade setup at these levels. An A-grade setup is characterized by three critical visual traits that you must learn to recognize instantly. First, the 1-minute trend is aligned with your trade direction. And when I say 1-minute trend, I mean you're looking at a 1-minute candlestick chart, and you're observing whether price is making higher highs and higher lows, that's bullish, or lower highs and lower lows, that's bearish. You're not checking daily charts, not checking 4-hour charts, just the 1-minute chart. If you're considering a long position from the previous day's value area low, you want to see that 1-minute chart showing higher highs and higher lows. The market is already moving in your favor. Second, and this is where the level history comes in, The volume profile level you're trading from has been respected multiple times in recent sessions. What I mean by this is, you're looking back at the past 2 to 3 trading days and checking whether the previous day's value area low as a volume profile level concept has bounced before. So yesterday, when you drew the previous day's VAL, did price respect it and bounce? The day before, when you drew that day's previous day's VAL, did it bounce? Now here's something absolutely critical about checking this history, and this is where many traders make a costly mistake. When we say bounced, we don't mean price had to touch the level perfectly at exactly 6,500.00. Remember, these levels work as zones, not laser lines. If price came within 2 to 3 ticks on the ES, or 4 to 6 ticks on the NQ, and showed a rejection candle with buyers stepping in, that counts as respecting the level. A near miss with a strong rejection wick is just as valid as a perfect touch. You're checking whether this particular volume profile label, this PD val designation, tends to get respected by the market, and respect can mean price approaching within the zone and bouncing. Don't demand perfection. Zones, not lines. This is crucial because institutional traders and algorithms worldwide are watching these same volume profile levels. When the previous day's val consistently bounces, whether perfectly touched or approached within 2 to 3 ticks, it tells you that market participants respect this 70% volume boundary. And third, this is your immediate confirmation you're seeing a strong rejection candle at or near the zone. For long positions at the value area low, that means a 1-minute candle with a long lower wick. The candle opens, drops down into or just below the val, remember, within 2 to 3 ticks counts, and then buyers aggressively push price back up, creating that long lower wick. That wick shows rejection buyers defended the level. For short positions at the value area high, it's the opposite. A long upper wick showing sellers stepped in with force. Now, when you identify an A-grade setup with all 3 factors aligned, your execution should be swift and decisive. Your entry comes on the very next candle after that rejection candle. You can enter on the market open of that next candle, or if you prefer precision, you can place a limit order within the zone, perhaps 2 to 3 ticks above the value area low for a long position. Again, don't obsess over getting filled at exactly 6,500. Anywhere within the zone works. Your stop loss should be placed just beyond the zone, covering the structure that protects the level. So, if you're going long from the previous day's value area low at, say, 6,500 on the ES futures, and there's a swing low at 64.95 just below the val, your stop goes perhaps 3 to 5 ticks below that swing low, maybe at 64.90. You're covering the zone and giving it breathing room to survive what we call the double tap test, when price retests the level before moving in your intended direction. Your target should be the nearest structure in the direction of your trade. If you're long from the previous day's value area low, you're targeting perhaps the previous day's point of control, or a recent swing high on the 1-minute chart. With A-grade setups, the market often moves quickly to these targets because there's strong directional momentum already in place. Let me give you a practical example to cement this concept. Imagine it's 10:15 a.m. Eastern Time on a Wednesday. You've already drawn your previous day's RTH volume profile. That's Tuesday's 9:30 a.m. to 4 p.m. session. Your previous day's value area low is marked in white at 6,500 on the ES futures. Now, before you even consider trading this level, you look back at recent history. Monday's previous day val, did it bounce? You check the chart. Yes, price came down to within 2 ticks of Monday's VAL, showed a strong rejection wick, and bounced twice that day. Tuesday's previous day VAL, did it hold? You check. Yes, buyers defended it in the morning session. Price approached within 3 ticks, rejected, and moved higher. So you now have confidence that the PD val as a volume profile concept is being respected by market participants. Notice neither day required a perfect touch. Both were near misses with strong rejections within the zone. You're watching price approach Wednesday's PD val at 6,500. You check your 1-minute chart. It's clearly bullish with higher highs and higher lows forming over the past 30 minutes. And then you see it, price comes down to 64.98, just 2 ticks shy of your val, and a beautiful bullish candle prints with a long lower wick, rejecting the approach. That is your A-grade setup. All 3 boxes are checked. Trend aligned, level has documented history of being defended within the zone, Strong rejection candle even though it didn't touch perfectly. You enter long on the next candle, perhaps at 65.02. Your stop goes below the value area low zone and beneath the swing low that protects it, maybe at 64.90. Your target is the previous day's point of control at 65.25, or perhaps a recent structure high at 65.30. You've just identified a high-confidence, high-probability trade that deserves aggressive position sizing within your risk management plan. This is the standard you're looking for. A-grade setups don't come around every 5 minutes. They require patience. But when they appear, you recognize them instantly because you understand the technical framework. What the volume profile levels are, when they form from 9:30 to 4 p.m. daily, how to draw them after the close, and most importantly, how to check whether that particular volume profile label has been respected in recent sessions, remembering that respect means within 2 to 3 ticks with rejection, not demanding a perfect touch. So remember, 1-minute trend aligned, the volume profile level has documented history of being defended within the zone. Strong rejection candle showing buyers or sellers stepping in. 3 boxes checked equals A-grade setup equals aggressive execution. Master this pattern recognition, and you'll transform your trading results dramatically.
All right, so essentially what I'm going to do is try to explain the narration with this example here on the chart. Now, guys, you can use volume profiles on anything, Forex, futures, whatever you want. The general concepts still apply. Now, I know that I said that you should use the 1 minute when it comes to looking at your volume profile areas. Now, I'm using the 15-minute specifically here on this example because it's a little bit easier to take a look at it. So as you can see on the previous value area lows, these 2 days, right, price respected it because price came down to this one. Although it didn't touch it, it was a few pips or ticks away from it, but still respected it, right? So price is still bullish. Now, when it comes to this day, price came down, still respected it, just a few ticks or pips below it, but overall we're still going bullish. So that lets me know that the idea of a previous day value area low, the concept itself, does hold or has been holding in these past day or 2 days or 3 days, however many days you want to use, right? So this will be the main session that we'll be looking for our trade in. So I'll go down to the 1 minute, right? And as you can see, price has been pretty bullish, right? It was bullish the day before. We had some liquidity that got generated. It got taken out on both ends, right? Kind of like a seek and destroy model that ICT talks about. And then we had this small breakup structure towards the upside, and then another one here on a major high. So internal or type 2 structure getting broken towards the upside, and then type 1 structure getting broken towards the upside. Same thing here, had a little bit of liquidity generated, but overall respected the previous day's value area low. So we had another breakup structure towards the upside, respects the point of control, comes down, taps into the previous day's value area low, strong wick rejection. We have a little tiny change in state of delivery. You can enter there, or you can enter up here, right? Stop loss either under that little low that's under the VAL, or just keep it like right here. I kept it under this little swing point right here, so you can keep it like right there and it's fine. And then you can target the point of control if you want, or you can target other nodes. You can target the previous day's value area high as well. It's up to you, but as you can see, that is essentially kind of what the side is talking about. Again, I operate in generalities when it comes to everything I teach, not absolutes. There's always times when certain rules, certain concepts can be a little bit more lenient. So, just keep that in mind. All right, so let's move on.
Now let's move on to B-grade setups. These are moderate confidence trades that require a different mindset and execution approach compared to your A-grade setups. And here's the crucial point. B-grade setups can be absolutely excellent trades, but they demand patience and confirmation before you commit capital. So what defines a B-grade setup? Well, these are characterized by 3 specific visual traits that tell you to proceed with caution. First, the 1-minute trend is currently against your trade idea. If you're looking to go long from the previous day's value area low, remember, that's the lower boundary of where 70% of volume occurred during yesterday's 9:30 a.m. to 4 p.m. regular trading hour session, but the 1-minute chart is showing lower highs and lower lows. That's a bearish trend working against your long position. This doesn't disqualify the trade, but it means you can't be aggressive. Second, the level still has a documented history of reactions. You look back at the past 2 to 3 trading sessions and you see that when the previous day's VAL was drawn on those days, price respected it and bounced. So the volume profile level concept has institutional respect. Market participants do react to this designation. This gives you confidence the level might hold again, despite the unfavorable trend. And third, you're seeing an initial wick or rejection candle, but it's not decisive. Perhaps you see a small lower wick at the value area low, but it's not the strong, aggressive rejection you'd want for an A-grade setup. Maybe there's some hesitation in the candle structure. Buyers are attempting to defend the level, but they're not showing overwhelming strength yet. This combination trend against you, level with history, but weak initial rejection, that's your B-grade setup. And here's the key. You do not enter immediately. You wait for confirmation triggers. What are these confirmation triggers? Well, you have several options to choose from, and you pick whichever suits your trading style. The first option is waiting for a strong move away from the zone. This means, after that initial hesitant rejection, you wait for a decisive impulse candle that closes well away from the level in your trade direction. If you're looking to go long, you want to see a strong bullish candle that closes significantly above the value area low, showing buyers have taken control. The second option is a micro break of structure in your trade direction. On the 1-minute chart, if you're going long, you wait for price to break a minor swing high, even if it's just a small 5-point swing. This shows buyers are winning the battle despite the broader bearish trend. For shorts from the previous day's value area high, you wait for a break of a minor swing low. And the third option, particularly useful for those of you who incorporate other methodologies, is waiting for a fair value gap fill plus continuation. After price moves away from the level, creating a gap in the candle structure, you wait for price to pull back into that gap and then continue in your direction. This provides additional confirmation that the move is legitimate. Now, here's something critical about B-grade setups. Your stop loss needs to be wider than it would be for an A-grade setup. Why? Because the trend is against you, you must anticipate that price will likely retest the level before moving in your intended direction. If you place your stop too tight, you'll get stopped out just before the trade works. So you give extra breathing room, perhaps 5 to 8 ticks beyond the zone and the protecting structure, rather than the 3 to 5 ticks you'd use for an A-grade setup. Let me give you a practical example to illustrate this. Imagine it's 3:45 a.m. Eastern Time. We're in the London session now. You've drawn your previous day's volume profile from yesterday's 9:30 a.m. to 4 p.m. session, and your previous day's value area high is marked in white at 65.50 on the ES futures. You're considering a short position from this level. You check the 1-minute chart. It's showing higher highs and higher lows, a bullish trend. This is against your short idea. Strike 1 for an A grade, but it doesn't disqualify the trade. You check the level history. Monday's previous day VAH bounced and rejected price, sellers defended it. Tuesday's previous day VAH also held, price approached it and got pushed back down. So the PD-VA concept has recent history of being respected. That's encouraging. You watch price approach 65.50. You see a candle with a small upper wick. Buyers tried to push higher, but sellers provided some resistance. It's not a massive rejection, just a hesitant one. This is your B-grade setup signal. You don't enter yet. You wait. And then you see it, a strong bearish candle closes well below 65.45, breaking a minor swing low on the 1-minute chart. That's your confirmation trigger. That's your micro break of structure. Sellers have taken control despite the broader bullish trend. Now you enter short, perhaps at 65.43. Your stop loss goes wider than an A grade, maybe 8 ticks above the value area high and above the recent swing high, perhaps at 65.62. You're giving this trade room to breathe because you're fighting the immediate trend. Your target is the nearest structure low, maybe at 65.20, or alternatively, the previous day's point of control at 65.15. The trade works, price moves down to your target. You've successfully traded a B-grade setup by exercising patience and waiting for confirmation rather than forcing the entry when conditions weren't optimal. This is the discipline that separates consistent traders from gamblers. B-grade setups demand you wait. You don't rush in just because you see a volume profile level. You wait for the market to prove that despite the unfavorable trend, the level is being respected and your trade direction is gaining momentum. So remember, trend against you, level with history. Initial but weak rejection, that's a B-grade setup. Wait for confirmation. Strong move away, micro break of structure, or fair value gap continuation. Use wider stops. These trades require patience, but they can be just as profitable as A-grade setups when executed with discipline.
All right, so this is an example for the Class B setups. Now, don't worry too much about this one right here because this is what we are going to be looking for when it comes to our trade. So instead, we are going to be looking at the previous day's volume profiles. So here, it's pretty obvious that price was aggressively moving down. Didn't really bother reacting too much in any of these volume areas. So obviously, this is a great indicator here that says, hey, we are very, very, very bearish. So we look at the previous day before that one. What do we have here? We have a volume area high that ended up getting swept, but still respected. Why do I say it's respected? Because as you can see, price did not continue moving towards the upside, meaning that the volume up here was just enough to where when price came down and broke structure towards the downside, it confirms to us that this was really nothing more than just a liquidity grab. So price is intention when it broke above the value area high, it only broke above temporarily to sweep some liquidity to continue towards the downside, which we have here. So I look at this and I say, okay, I'm going to start looking for shorts, hopefully near or at the previous day's volume area high. So I'm going to drop down to that 1 minute time frame. Now I'm going to turn off the indicator so that way you guys can better view it. Now, when it comes to Class B setups, what can we see here? Price is going to dance around the previous day's volume area high or volume area low, depending on, what you're looking at, obviously. So in this case here, what do we have? We have price somewhat consolidating over it, under it, over it, and under it. So finally, once we find a time or setup or a trade that we like, then it's time to enter. Now, if I'm being honest, there are a couple of times where you can get stopped out. So that's why it's best to wait for a time window to show up. In this case, we would be the 9:30 here. So right here would be around the 9:30 open. Okay. So once that 9:30 open hits, then we can start looking for our setups. Why is it that we're looking specifically for that 9:30 open? Because that's when volume starts coming in, right? That's when most traders with most money start coming in to trade the New York Stock Exchange. So that is another way that you guys can avoid getting stopped out or being turned into liquidity when trading anything in general, right? You want to look for an area or a time window that has the most amount of liquidity to push price in a general direction, whether it's upward or downward. Why? Because the more volume you have, the more fuel you're giving the market to move in a specific direction. So as you can see here, we have that 9:30 open. Price is already rejecting fairly aggressively here with this bearish candle, right? Now we still want a little bit more confirmation because we're not getting too much of a strong break of structure here towards the downside, right? We wanted to look for shorts because everything that we already looked at beforehand said it's time to short. So we have this area here that, right, that area that failed to break structure towards the upside. So that just gives us a little bit more of a confirmation. So we have the break of structure down here. We have the 9:30 time window, this big bearish candle coming down, right, helping or trying to help break some structure towards the downside, but still not quite enough yet. So what I am looking for is a retracement, maybe into a fair value gap, maybe a change in state of delivery, maybe a little bit of everything, right? So we have this bearish fair value gap here, All right. Price comes up, sweeps it just a little bit, but does not break above the fair value gap, nor does it break above this volume area's high, right? The previous day volume area's high. So what do I want? I want like a small change in character or change in state of delivery, something that just tells me it's time to move. And here we are, right? Now, you guys can either enter really aggressively, which would be once the candle breaks slightly below this low, you could enter like somewhere around here. Or if you want to wait for price to finish closing, but now you have more confidence in the trade because you have all these big bearish candles. So really what you could do is just set your stop loss right here at the area where the change in state of delivery occurred, or that microstructure shift, whatever you want. Or if you want to be even more safe, just keep it right here, slightly a few ticks or pips above that previous day's volume area high. And what you can do is, since we're already past the point of control, and since we know we're bearish, we can target this volume area low, and you still get a 1.26 R. That's still really, really good money, guys. Really good money. So that's just a way that you guys can trade with a class B or type B setup, okay? But you have to be very specific. You have to be very careful. There's many ways, again, guys, that you can trade with volume profiles. Just have some fun, experiment, open up the charts, backtest a little bit. You don't have to do everything I tell you guys. Remember, this is just some general rules, some general guidelines that I like to stick to. But at the end of the day, it's up to you and what you like to experiment with.
C-grade setups. Skip these entirely. Welcome to perhaps the most important slide in this entire advanced course, C-grade setups and why you must skip them entirely. Let me be absolutely clear from the outset. C-grade setups are not trades. They are temptations. They are noise masquerading as opportunity. And if you want to build a sustainable trading career, you must develop the discipline to walk away from these setups without hesitation. What makes a setup C-grade? It's simple, really. A C-grade setup lacks the fundamental characteristics that give you an edge. Specifically, you're looking at a situation where one or more of these critical deficiencies exists. First deficiency. The level has NO documented history. You're watching price approach the previous day's value area low at, let's say, 6500. But when you look back at the past 2 to 3 sessions, this specific volume profile level, the concept of the PD val, has never been tested before. There are no bounces, no role reversals, no evidence whatsoever that market participants respect this level. It's untested territory. Remember, levels work because of market memory. Institutions, algorithms, and professional traders watch these levels and react to them based on historical behavior. If there's no history, there's no memory. And if there's no memory, you have no edge. Second deficiency. The 1-minute trend is choppy, sideways, or completely unclear. You're not seeing higher highs and higher lows for a bullish bias, nor lower highs and lower lows for a bearish bias. Instead, you're watching price whipsaw back and forth, making overlapping swings with no clear directional momentum. This is market indecision at its finest, and it's the exact environment where forced trades die painful deaths. Third deficiency. The rejection candle is weak, non-existent, or ambiguous. Instead of a strong bullish pin bar with a long lower wick showing decisive rejection at the PD val, you see a small doji, an inside bar, or worse price just drifting near the level with no reaction whatsoever. This tells you that market participants are not stepping in. There's no commitment, no conviction, no institutional interest. Now, let's combine these deficiencies into a practical scenario. It's Tuesday morning during the New York session. Price is approaching the previous day's value area high at 6550. You're thinking about a short entry because it's resistance, right? But here's what you observe. The PD VA hasn't been tested in the past 3 sessions, no prior bounces, no documented history at this level. Your 1-minute chart is showing choppy price action from the 9:30 a.m. open overlapping candles, no clear trend direction, just noise. And when price touches 6552, you see a small inside bar with tiny wicks on both sides, no rejection, no commitment from sellers. This is textbook C-grade. Level with no history, choppy trend, weak rejection, you have 0 factors aligned in your favor. This is not a trade, this is a gamble. Here's what separates professional traders from amateurs. Professionals have the discipline to do nothing. Amateurs feel compelled to trade because they're watching the charts, they're ready to trade, and they convince themselves that they need to act. This is how accounts get destroyed, one forced C-grade setup at a time. Let me give you the absolute rules for C-grade setups. These are non-negotiable. Rule 1. If the level has no history, do not trade. I don't care how perfect the rejection candle looks. I don't care if the trend seems clear. If the level hasn't been respected in recent sessions, you have no basis for expecting it to hold now. Rule 2. If the 1-minute trend is choppy or unclear, do not trade. Choppy conditions breed whipsaws, stop-outs, and frustration. Wait for clarity. Wait for structure. Wait for the market to show you a clear directional bias before risking your capital. Rule 3. If there's no strong rejection candle, do not trade. A weak candle means weak participation. If institutions aren't interested, you shouldn't be either. Wait for that long wick, that engulfing pattern, that decisive move away from the level that says, yes, this level matters. Rule 4. If you're forcing the trade because you're bored, frustrated, or feel like you need to do something, step away from the charts, go for a walk, read your Bible, do anything except press that entry button. Boredom and frustration are the enemies of disciplined trading. Now, I know what some of you are thinking, but what if the trade works? What if I skip a C-grade setup and it moves in my direction? Here's the truth. You will occasionally miss moves by skipping C-grade setups. But over the course of 200 trades, 500 trades, 1,000 trades, your statistics will be exponentially better because you protected yourself from low-probability gambles. Professional trading is not about catching every move. It's about stacking probabilities in your favor and only risking capital when you have a legitimate edge. C-grade setups do not provide an edge. They provide a 50-50 coin flip at best, and in reality, the odds are worse than 50-50 because you're fighting against unclear market conditions. Let me share a powerful mindset shift that will change your trading career. Every time you skip a C-grade setup, you win. You didn't lose money. You didn't take a stop loss. You didn't damage your emotional state with a frustrating, choppy trade. That's a victory. Celebrate the discipline to do nothing. I want you to internalize this concept deeply. Not trading is a trading decision. Choosing to skip a C-grade setup is an active, professional choice that protects your capital and keeps you ready for A-grade setups when they appear. Here's a practical example to drive this home. Let's say you're watching ES futures during the London session. Price approaches the overnight point of control at 6525. You check your 3 factors. Factor 1. Level history. You look back at the overnight profile from Monday and Tuesday. The overnight POC wasn't tested either night. No history. Strike 1. Factor 2. 1-minute trend. Your chart shows overlapping candles from 3 a.m. to 4 a.m. No clear higher highs, no clear lower lows. Choppy. Strike 2. Factor 3. Rejection candle. Price touches 6525 and prints a small inside bar with equal wicks. No rejection. Strike 3. This is a C-grade setup. You do nothing. You mark the level on your chart for future reference, but you do not enter a trade. 30 minutes later, price whipsaws around that level, hitting would-be stop losses in both directions before finally drifting lower. You protected your capital by recognizing this was not a trade. Key takeaways for C-grade setups. 0 or 1 factor aligned. Is C-grade skip immediately without hesitation. Protect your trading statistics by avoiding low-probability setups. Discipline to do nothing is a professional skill. Master it. Wait for A-grade or B-grade setups where the edge is clear. Remember, skipping a C-grade setup is a win, not a missed opportunity. One final thought. Volume Profile gives you incredible precision in identifying high-probability trading opportunities, but it only works if you have the discipline to wait for those opportunities. If you trade every level touch regardless of history, trend, or rejection quality, you're not using the methodology, you're gambling with extra steps. Be patient. Be selective. Honor the C-grade classification by skipping these setups entirely. Your account balance will thank you, and your confidence will grow because you're only taking trades with legitimate edges. Remember, professionals trade probabilities, not possibilities. C-grade setups are possibilities without probabilities. Skip them and move on.
Welcome to the heart of this advanced volume profile methodology, the three-factor analysis framework. This is the systematic, repeatable process that will transform how you evaluate every single trade opportunity. Let me establish something critical right from the start. Trading without a framework is gambling. You might win occasionally through luck or intuition, but over time, inconsistency will destroy your account. The three-factor analysis gives you structure, repeatability, and most importantly, objectivity in an inherently subjective market. So what are these three factors? Let me introduce them. Factor 1, level history. What the market has done at this specific volume profile level in recent sessions. Has the previous day's value area low bounced multiple times? Has the weekly point of control acted as a pivot? This factor measures market memory and institutional behavior. Factor 2, trend definition. Where price is moving on your 1-minute chart relative to your intended trade direction. Are you trading with the micro trend or against it? This factor determines where the momentum is on your side or working against you. Factor 3, rejection candles. What price action is telling you right now at the level? Is there a strong bullish pin bar with a long lower wick, a bearish engulfing candle with conviction, or just a weak doji with no commitment? This factor measures real-time market participation. Now, here's the beauty of this framework. These three factors work together as a scoring system. Each factor can be scored 0, 1, or 2 points, depending on its strength. Add up the scores, and you get an objective classification. 5 to 6 points total, that's an A-grade setup. Aggressive entry, tight stop, high confidence. 3 to 4 points, B-grade setup. Wait for confirmation, use wider stops, moderate confidence. 0 to 2 points, C-grade. Skip entirely, protect your statistics, no edge present. This isn't guesswork. This isn't feeling the market. This is a systematic evaluation that you can apply to every single level touch, every session, every day. And over time, this consistency compounds into sustainable profitability. Let me give you a quick walkthrough of how this works in practice. It's 10:30 a.m. during the New York session. Price approaches the previous day's value area low at 6500. You immediately begin your three-factor analysis. Factor 1, level history. You look back at Tuesday's RTH session and Wednesday's London Open. Both times this PD val bounced with strong rejection. That's 2 documented reactions. Score, 2 points. Factor 2, trend. Your 1-minute chart shows higher highs and higher lows from the 9:30 a.m. open. The micro trend is bullish, aligned with your long bias from support. Score, 2 points. Factor 3, rejection candle. At the PD val, price prints a bullish pin bar with a long lower wick showing buyers stepping in decisively. Strong rejection present. Score, 2 points. Total score, 6 out of 6. This is a textbook A-grade setup. You enter long immediately on the next candle with a tight stop just below the zone. Now contrast that with a different scenario. Same PD val at 6500, same New York session, but this time, factor 1, level history. You check the past 2 sessions, this PD val haven't been tested before. No history. Score, 0 points. Factor 2, trend. Your 1-minute chart is choppy, overlapping candles, no clear direction. Score, 0 points. Factor 3, rejection. Price touches the level and prints a small inside bar with tiny wicks, no conviction. Score, 0 points. Total, 0 out of 6. C grade. you skip this setup entirely without hesitation. Same level, same time of day, completely different evaluation based on objective criteria. This is the power of systematic analysis. Now, over the next 4 slides, we're going to deep dive into each of these 3 factors individually. You'll learn exactly what to look for, how to score each factor, and how to avoid the common mistakes that sabotage traders who lack this framework. But before we move forward, I want you to internalize this mindset shift. Every trade decision is a 3-factor evaluation. No exceptions, no shortcuts. If you can't score all 3 factors objectively, you don't have a trade, you have a gamble. This discipline separates professional volume profile traders from amateurs who chase every level touch and wonder why their accounts bleed slowly over time. Key takeaways for the 3-factor analysis framework. 3 independent factors must be evaluated for every setup: level history, trend definition, and rejection candles. Each factor is scored 0 to 2 points based on strength and alignment. Total scores classify setups. 5 to 6 equals A-grade aggressive entry. 3 to 4 equals B-grade confirmation required. 0 to 2 equals C-grade skip entirely. Apply this framework systematically to every level touch. No exceptions, no emotional overrides. Consistency in evaluation creates consistency in results. This is how you build trading statistics that compound over time. Remember, the market doesn't care about your opinions, your emotions, or your account balance. It only responds to probability. The 3-factor analysis ensures you're trading with probabilities, not against them. Let's now dive deep into Factor 1, level history, and learn how to read the market's memory.
Welcome to Factor 1 of our 3-factor analysis, level history. This is where you learn to read the market's memory and understand which volume profile levels truly matter. Let's establish the fundamental principle. Markets have memory. Institutions, algorithms, and professional traders watch specific price levels and react to them based on historical behavior. When a level has been respected multiple times in the past, it carries weight. When a level has never been tested, it's just a line on a chart with no institutional interest. Your job as a volume profile trader is to identify which category your level falls into before risking capital. And Factor 1 gives you the systematic process to do exactly that. So, what does it mean to check level history? It means looking back the past 2 to 3 trading sessions and asking one critical question. Has this specific volume profile level concept been respected before? Let me clarify what I mean by volume profile level concept. We're not asking whether a specific price point has bounced. We're asking whether the previous day's value area low as a concept or the weekly point of control as a concept has shown reactions in recent sessions. For example, if you're evaluating the previous day's VAL today at 6500, you check, did the PD VAL bounce on Tuesday? Did it bounce on Wednesday? If yes, that volume profile label carries market memory. If no, it's untested. Now here's the critical nuance we covered earlier in Slide 7's call-out box. Levels are zones, not laser lines. This applies directly to checking level history. When you're reviewing whether a level has been respected, you do not need to see perfect price touches at the exact level. Near misses count. If price came within 2 to 3 ticks on ES futures or 4 to 6 ticks on NQ futures and showed rejection, that level has been respected. Why? Because institutional order flow operates in zones, not at precise price points.
Welcome to Factor 2 of our 3-factor analysis, trend definition. This is where we determine whether momentum is on your side or working against you. I'm going to teach you the simplest, most effective trend definition method you'll ever use. Let's address the elephant in the room first. Trend analysis can become absurdly complicated. Moving averages, exponential MAs, MACD crossovers, RSI divergences, the list is endless. And here's the truth. For volume profile trading at key levels, all of that complexity is unnecessary noise. You need one chart, one time frame, one simple visual rule. That's it. Here's the framework. The 1-minute chart is your only tool for trend definition. Not the 5-minute, not the 15-minute, not the hourly, just the 1-minute chart. You're looking at price structure from left to right across your screen. Why the 1 minute? Because volume profile levels are precision entry tools. You're entering at specific zones, value area lows, points of control, value area highs. These are micro-level decisions, and they require micro-level trend analysis. The 1-minute chart gives you real-time clarity on whether buyers or sellers are in control right now. Let me give you the ultra-simple definitions. Bullish trend, higher highs and higher lows as you scan left to right across your screen. Prices moving upward over time. Each swing high is higher than the previous high. Each swing low is higher than the previous low. Visual momentum is pointing up and to the right. Bearish trend, lower highs and lower lows. Prices moving downward over time. Each swing high is lower than the previous high. Each swing low is lower than the previous low. Visual momentum is pointing down and to the right. Choppy or no clear trend. Overlapping swings, equal highs and lows, sideways movement, prices whipsawing back and forth with no clear directional bias. This is market indecision, and it's toxic for trading. That's it. No indicators, no complex analysis, just visual structure. Can a 10-year-old child look at your 1-minute chart and tell you whether the price is moving up, down, or sideways? If yes, you've got your trend definition. Now let's connect this to scoring factor 2. If the 1-minute trend is aligned with your trade idea, you score 2 points. For example, you're looking to go long from the PDVAL, and your 1-minute chart shows higher highs and higher lows. Momentum is bullish. You're trading with the trend, 2 points. If the 1-minute trend is against your trade idea, you score 0 points. You're looking to go long from the PDVAL, but your 1-minute chart shows lower highs and lower lows. Momentum is bearish. You're fighting the trend, 0 points. If the 1-minute trend is choppy or unclear, you score 0 points. Regardless of your trade direction, if the price is overlapping and sideways, you have no momentum edge, 0 points. Let me emphasize something crucial here. Trend definition is binary for practical purposes. You either have momentum alignment, 2 points, or you don't, 0 points. There's no middle ground worth trading. Why? Because momentum is your friend. Trading with a bullish micro trend when you're long from support dramatically increases your probability of success. Institutional buyers are already stepping in, algos are already pushing price higher, and you're joining the existing flow. Conversely, trading against a bearish micro trend when you're trying to go long, you're hoping that the current momentum reverses just because price hit a level. That's a B-grade setup at best. You'll need confirmation. And if the trend is choppy, you're gambling on randomness. Let me walk you through 3 practical examples to make this crystal clear. Example 1. Aligned trend, long setup. It's 10:15 a.m. during the New York session. Price is approaching the previous day's point of control at 6525 from below. You're considering a long entry. You check your 1-minute chart from 9:30 a.m. onward. You see higher high at 6510, pull back to a higher low at 6505, another higher high at 6518, another higher low at 6515. Price is making higher highs and higher lows consistently, moving up and to the right. The micro trend is bullish. Your trade idea is long. Trend is aligned. Factor 2 score, 2 points. Example 2, conflicting trend, long setup. Same PD pocket 65.25. You're considering a long entry, but your 1-minute chart from 9:30 a.m. shows lower high at 65.45, lower low at 65.30, another lower high at 65.35, another lower low at 65.20. Prices making lower highs and lower lows moving down and to the right. The micro trend is bearish. Your trade idea is long. Trend is against you. Factor 2 score, 0 points. This downgrades your setup to B grade. You must wait for confirmation if you proceed at all. Example 3. Choppy conditions. PD POC at 65.25 again. Your 1-minute chart shows swing high at 65.30, swing low at 65.15, another swing high at 65.30, another swing low at 65.15. Prices overlapping the same range, making equal highs and lows with no directional bias. The micro trend is choppy. Regardless of whether you're considering long or short, you have no momentum clarity. Factor 2 score, 0 points. This is a warning sign. Skip the trade unless other factors are overwhelmingly strong. Now let's address a common question. What if the 5-minute chart shows a different trend than the 1-minute chart? My answer? Ignore the 5-minute for this methodology. The 1-minute is your execution time frame, and it's the only time frame that matters for factor 2. Why? Because you're entering at precise volume profile levels with tight stops. The 5-minute trend might be bullish, but if the 1-minute is bearish when you're entering long, you're going to get stopped out before the 5-minute trend matters. Stick to the 1-minute. Here's a critical mindset shift. Trend definition is not about predicting where the price will go. It's about observing where the price is going right now and aligning your trade with current momentum. You're not a fortune teller. You're a probability trader. Another practical tip: use the visual language of left to right when analyzing your chart. Literally, look at your screen from left to right and ask, is price climbing higher as I move right? Is it dropping lower? Is it stuck in the same range? This simple visual approach removes overthinking and keeps you decisive. Key takeaways for factor 2. Trend definition. Use the 1-minute chart only, no other time frames for this factor. Bullish trend, higher highs and higher lows moving up and right. Bearish trend, lower highs and lower lows moving down and right. Choppy, overlapping swings, no clear direction. Score 2 points if the trend is aligned with your trade, 0 points if against or choppy. Trading with the trend is an edge. Trading against the trend is a disadvantage. Trading in choppy conditions is gambling. Keep it ultra simple. If a child can identify the trend direction, you're doing it correctly. Now let's move to factor 3, rejection candles, and learn how to read real-time price action at volume profile levels.
Welcome to Factor 3 of our 3-factor analysis, rejection candles. This is where you learn to read what the market is telling you right now at volume profile levels. Rejection candles are your real-time confirmation that institutional participants are stepping in at a level. They show you, in that exact moment, whether buyers or sellers have conviction when price touches support or resistance. Factor 1 tells you what happened in the past at this level. Factor 2 tells you where momentum is going based on recent structure. But Factor 3 tells you what's happening right now. And for precision entries at volume profile levels, this real-time information is absolutely critical. So what defines a strong rejection candle? It's simple. A candle with a long wick in the direction opposite to your trade, showing that price was rejected from that zone decisively. For long entries from support, like the previous day's value area low, you want to see a bullish rejection candle. This means a candle with a long lower wick. Price dipped into or toward the val, buyers stepped in aggressively, and price was pushed back up. For short entries from resistance, like the previous day's value area high, you want to see a bearish rejection candle. This means a candle with a long upper wick. Price spiked into or toward the VAC, sellers stepped in aggressively and price was pushed back down. If you see a strong rejection candle, long wick, decisive move, clear commitment from institutions, you score 2 points. This is your green light for aggressive entry. If you see a moderate or weak rejection candle, short wick, small doji, inside bar with minimal commitment, you score 1 point. If you see no rejection candle, price just drifts near the level with no reaction, or worse, blows straight through the level, you score 0 points. Institutions are not interested. Do not trade. Example 1. Strong bullish rejection. Price approaches the previous day's POC at 65.25 during the New York session. At 10:32 a.m., a candle prints with a long lower wick, showing strong rejection. Factor 3 score 2 points. Example 2. Strong bearish rejection. Price rallies toward the overnight VAC at 65.50 during the London session. At 4:15 a.m., a candle prints with a long upper wick, showing strong rejection. Factor 3 score 2 points. Example 4. No rejection. Price drifts toward the weekly POC at 65.30. A candle prints. Price blew straight through the level with no pause. Factor 3 score 0 points. Remember, rejection candles show real-time institutional commitment. This is your confirmation to enter or skip. Always evaluate Factor 1 with Factor 2 and give equal weight to Factor 3 for complete setup classification. The market speaks through price action. Rejection candles are its voice. Learn to listen and you'll know exactly when to act and when to step aside. Now let's move to slide 10, the 3-factor decision matrix, where we bring all 3 factors together into a complete scoring system.
Welcome to the 3-factor decision matrix, where we bring everything together into a complete objective scoring system for every trade decision. This is the moment where theory becomes practice. You've learned the 3 factors individually: level history, trend definition, and rejection candles. Now I'm going to show you exactly how to score them, add up the totals, and classify every single setup you encounter. Let's establish the framework. Each of the 3 factors can be scored 0, 1, or 2 points based on its strength and alignment with your trade idea. Factor 1, level history. Score 2 points if the volume profile level has been respected 2 or more times in the past 2 to 3 sessions, multiple documented bounces or role reversals. Score 1 point if the level has been tested only once with a single reaction. Score 0 points if the level has never been tested. No history, no memory, no edge. Factor 2, trend definition. Score 2 points if the 1-minute microtrend is aligned with your trade direction, higher highs and higher lows for longs, lower highs and lower lows for shorts. Score 0 points if the trend is against you or choppy. There is no middle ground here. Trend is either with you or against you. Factor 3, rejection candles. Score 2 points if you see a strong, decisive rejection candle with a long wick showing institutional commitment. Score 1 point if the rejection is present but weak, small wick, modest participation. Score 0 points if there's no rejection or price blows through the level. Now add up your 3 scores. You can achieve a total between 0 and 6 points. And here's how you classify the setup based on that total. 5 to 6 points total. A grade setup. This is high confidence. All factors are strongly aligned. You have level history, trend alignment, and strong rejection. Enter aggressively on the next candle. Use tight stops, 3 to 5 ticks beyond the zone. Target the nearest structure. This is your bread and butter trade. 3 to 4 points total. B grade setup. This is moderate confidence. 2 factors are aligned, but one is missing. Typically, the trend is against you.
Do not enter immediately. Wait for confirmation, a strong move away from the zone, a micro break of structure, or an advanced concept like fair value gap fill. Use wider stops, 8 to 12 ticks beyond the zone. Expect lower win rates than A grades, but these are still valid trades when confirmation appears. 0 to 2 points total. C grade setup or no confidence. Skip this setup entirely. Protect your statistics. One or fewer factors aligned means you're gambling, not trading probabilities. Walk away without hesitation. Celebrate the discipline to do nothing. Let me give you 5 real-world scenarios to demonstrate how this matrix works in practice. Remember, trading is not about catching every move. It's about stacking probabilities in your favor and only risking capital when you have a legitimate edge. The 3-factor decision matrix ensures you're always trading with an edge, never against one. Now, let's move to slide 11, technical setup requirements, and ensure your charting environment is configured correctly to execute this methodology.
Welcome to an important topic, technical setup requirements. To follow this specific volume profile methodology as taught in this course, I'm going to walk you through the recommended charting environment and settings. These recommendations are based on what works best for institutional-grade volume profile analysis on ES and NQ futures, which is the focus of this training. Now, before we dive in, let me be clear. Volume profile trading is a versatile methodology. It works across Forex, crypto, stocks, and other markets. There are also free volume profile indicators available that many traders use successfully. What I'm sharing here are the recommended tools and settings for this particular course, specifically for trading ES and NQ futures with the precision we're teaching. Think of this as the optimal setup rather than the only setup. Let's work through each recommendation systematically. First, your trading platform. For this course, we recommend TradingView with at least the Essential plan. As of 2025, that's $16.95 per month. Why do we recommend this specific plan? Because the Essential plan gives you access to the fixed range volume profile tool with full customization capabilities that we'll be using throughout this training. Now, there are free alternatives and other platforms that offer volume profile indicators. If you're trading on a tight budget or prefer a different platform, you can certainly adapt this methodology. However, for the purposes of following along with this course and ensuring your levels match exactly what we're teaching, TradingView Essential is what we recommend. I also recommend using the TradingView desktop application rather than the web browser version. The desktop app tends to be faster and more stable during live trading sessions, though the web browser version will work if that's what you prefer. Second, your instruments. This course is specifically designed for ES and NQ futures, E-mini S&P 500 and E-mini Nasdaq 100. These are the instruments we'll reference throughout all examples, case studies, and training materials. Can you apply volume profile to Forex, crypto, or other futures? Absolutely, volume profile is a universal concept. However, there are important considerations. Futures contracts provide real, verifiable volume data from the CME exchange, which shows actual institutional order flow. Forex uses tick volume or broker-specific volume, which is different. Crypto volume varies by exchange. CFD charts use simulated volume. If you plan to trade Forex or crypto using this methodology, just be aware that your volume profiles may differ from ours and you'll need to adjust your understanding of what the volume represents. For this course, we're focusing on ES and NQ futures, where the volume data is standardized and institutional grade. Third, real-time data. For accurate volume profile analysis, we recommend real-time market data for ES and NQ. There are a few ways to access this. Option 1. Subscribe to the CME data package directly through TradingView. This typically costs around $5 to $10 per month, depending on your subscription bundle. Option 2. If you're trading through a funded evaluation program like Apex Trader Funding, they often provide real-time CME data access as part of your evaluation account.
Option 3. If you're on a tight budget and starting out, you can use delayed data for practice and paper trading. Just understand that 15-minute delays will limit your ability to trade live setups in real time. It's fine for learning and backtesting, but not ideal for live execution. Fourth, your primary time frame. All volume profile drawing and analysis in this methodology is done on the 1-minute chart. This is a core principle of the approach we're teaching. Why the 1 minute? Because volume profile levels are precision entry tools, and the 1-minute time frame gives you the granularity you need for institutional grade profiles. Can you use 5-minute or 15-minute charts? Yes, and many traders do, but the levels will be slightly different and you won't be matching our examples exactly. For this course, stick to the 1-minute chart for profile drawing. You can absolutely use higher time frames for additional context, checking daily charts for major levels or 4-hour charts for trend. But when drawing your fixed range volume profiles, use the 1 minute. Fifth, your time zone setting. This is critical for session accuracy. We recommend setting your TradingView time zone to New York local time, either UTC-4 or UTC-5 depending on daylight saving time. Why New York? Because all session times in this methodology are referenced in Eastern time. Regular trading hours are 9:30 a.m. to 4 p.m. Eastern. Overnight Globex opens at 6 p.m. Eastern. London starts at 3 a.m. Eastern. If your time zone is set differently, you'll need to mentally convert session times, which adds unnecessary complexity. For simplicity and accuracy with this course, we recommend New York time zone. To check, open TradingView, click Chart Settings, scroll to Time Zone, and select Exchange or manually choose New York. Now, here's the most critical setting for following this specific methodology: your row size setting for the fixed range volume profile tool. This is the one setting where precision really matters. Let me walk you through it step by step. Step 1. Open TradingView and load an ES or NQ 1-minute chart. Step 2. In the left-hand toolbar, find the Fixed Range Volume Profile tool. It looks like a vertical histogram icon. Click it. Step 3. Draw a profile on your chart, for example, from yesterday's 9:30 a.m. open to 4 p.m. close for the previous day RTH. Step 4. Once drawn, click on the profile to open settings. Step 5. Locate the row size field. For this course, we recommend setting row size to 1000. Type 1000 into this field. Why 1000 specifically? Because this is the granularity used by many institutional traders and algorithms for ES and NQ. It ensures your value area high, value area low, and point of control align with the levels that large participants are watching. Now, can you use different row sizes? Yes, some traders prefer 500 for finer detail or 2000 for broader zones. It depends on your trading style, but if you want your levels to match ours exactly throughout this course, use 1000. This is our recommended standard. Sixth, additional volume profile settings. While you have the settings open, we also recommend rows layout set to rows, value area volume set to 70%, show VAH checked, show VAL checked, and show POC checked. These ensure your profiles display all 3 critical levels we trade: value area high, value area low, and point of control. Seventh, color coding your levels. For visual consistency, we recommend this color scheme: orange lines for weekly levels, white lines for daily RTH levels, blue lines for overnight levels, green lines for developing session levels. This isn't mandatory, use whatever colors work for you, but this scheme makes it easy to instantly recognize which session a level belongs to, especially when managing multiple profiles simultaneously. Eighth, a quick daily checklist. Before trading each day, we recommend verifying platform and plan active, correct instruments loaded, ES or NQ futures for this course, real-time or appropriately delayed data, 1-minute chart selected, time zone set correctly, volume profile tool configured with row size 1000, color-coded levels drawn for all sessions.
If you're following along with this course and want your setup to match ours, this checklist ensures consistency. Key takeaways for technical setup requirements. This course recommends TradingView Essential Plan for full functionality, though alternatives exist. We focus on ES and NQ futures for standardized institutional volume data, though volume profile works across markets. Real-time data is recommended for live trading, delayed data works for learning. 1 minute chart is our recommended time frame for profile drawing in this methodology. New York time zone recommended for session accuracy. Key recommended setting row size is 1000 for matching hour levels exactly. Color coding recommended orange weekly, white daily, blue overnight, green developing. Daily checklist ensures consistency if following this specific course methodology. Remember, these are recommendations for optimal results with this training program. Volume profile is flexible and works across many markets. But if you want to match our examples, follow along seamlessly and ensure your levels align with what we're teaching, these are the settings and tools we recommend. Now that we've covered the technical foundation, let's continue to slide 12. Levels are zones and not laser lines, and refine your understanding of how volume profile levels function in real market conditions.